Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Ice raw sugar in New York. I know I've been going on about this for some while now, but the core of the bullish support here for this market continues to be the lower time, which is highlighted in dark blue on my daily chart, of the December 2020 to April 2021 bullish shift pitchfork, currently at 1839. Since November last year and until the recent changeover gap in February, the late October 2022 to early January 2023 bullish Andrews pitchfork seem to have taken over the running higher of this market. However, that recent relationship is now over, and instead, the shallower bullish shift pitchfork for the same move, highlighted in purple on my daily chart, has instead taken the lead. The market is now in between the lower time, below, currently at 2025, and with the support of the close at hand, rising medium moving average, currently 2016, whilst above we have the middle time, currently at 2152. In amongst all this is the middle time in dark blue, currently 2063, of the original December 2020 to April 2021 bullish shift pitchfork. We also have running interference on the market, the 50% Fibonacci line for 2023 at 2064, the November last year high at 2048, and the slowly rising short medium moving average, currently 2068. All this is in the shadow of January's monthly key reversal up. So, as I've said previously, a few weeks ago I took a look at the long-term charts, and there was the answer to the question I'd previously posed on where next for this market. See, we had a secondary harder to reach target in a 2140 area for the diamond bottom formed over 2019 to 2020. In late January, the market rose up towards the resistance of the neckline, currently at 2214, of the August and November 2021 complex head and shoulders top, which is highlighted in bright red on my daily chart, and where prices have peaked and been capped ever since, with one minor exception, which can in hindsight be seen as an aberration. I have a suspicion that despite it being a changeover gap, the market may well try to fill that gap, originally between 2065 to 22 even, and now between 2133 and 22 even. However, I'm minded to perhaps set aside the peak and instead look for a sufficient gap filling to be up to the 4 Fridays ago low of 2123, which it has indeed already filled. I know this is optimization, and to some perhaps too much optimization, but I'm minded right now to look at it that way, especially if prices try, as they seem to be doing, try to establish themselves over the middle time. Ice Europe white sugar in London. As I've repeated here for many months now, changeovers produce some strange events. Since mid-September last year, the market has been dominated by one action, the changeover gap that happened back then. Now, one can say a lot of things about what happened beforehand, but that changeover gap here, seen on the continuous daily chart, was really, really big. There has been a number of attempts since to try and fill it, but it has been a laborious process. The most recent attempt 2 weeks ago has been quite valiant, reaching up over the middle time, currently 580.40, which is highlighted in dark blue on my daily chart, and that's of the late October to late November 2022 bullish shift pitchfork, as well as the neckline, currently at 591 even, and highlighted in bright red, of the August to December 2021 complex head and shoulders top, even closing just the once over the November 2016 high at 590 even. Now, since that high, we've seen a pullback, but please note the pullback so far has been limited. We have pierced last week the middle time, but there was no closes below it, not yet at least. Overall, despite this pullback, I still think for now that the integrity of the bullish shift pitchfork, and to a certain degree the integrity of the rising neckline, which is in parallel step with the middle time, still seem to be driving this market higher. And I have a strong suspicion that the big old changeover gap may well see further attempts to try and fill it. Sugar white premium spread. We are again well into 2023, and this chart continues to be very colourful. Many things are going on all at the same time. Okay, so I'd previously spoken about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart, with the market at the moment in between the lower time below, currently 92.5, and the middle time above, currently 166.75. I have said this so many times before, and I will repeat it yet again. This pitchfork, despite being breached in the past, still continues to show the overall major bullish angle of attack. Next, we have an ascending expanding wedge pattern, highlighted in bright red trend lines, and above the current market. This was formed between mid-April to late November last year, currently at 167, even to right off the top of my weekly chart so far, it doesn't really matter. To me, it was and still is not the best looking of such patterns, but it is also still out there. And it comes with all the possibilities such a pattern invokes. The most recent activity had been the market's move up to the slowly rising long moving average, currently at 128.25, as well as the 50% Fibonacci lines at 128.75 and 131.5, as well as the June 2020 high at 134 even. This logjam of resistances above seemed to have stalled prices, though we are now seeing indecision up here on whether the market should stall with a weekly indecisive doji cross, followed 2 weeks ago by a weekly bearish engulfing pattern, followed by last week's immediate countering bullish engulfing pattern, such that whilst we may be stalled, it has not stopped the market from testing up towards the resistances. We now also have below the, let's be honest, dubious support of the declining medium moving average, currently 117.5. Until the market either absorbs and builds on the congestion between 128 to 134, or else fully rejects it with confirmatory closes well below, until one of these two things happen, then we will see a sort of limbo right now. All this is in the shadow of the monthly key reversal up we saw here in February.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.